turning to the broader economy, Goldman, speaking of Goldman, reduces its recession odds from 45% down to 35% and raises the growth forecast for the U.S. following that trade war détente with China. Goldman Sachs chief U.S. economist David Mericle joins us here at Post 9. David, great to have you back. Thanks for the time.
For having me.
So we've talked a lot about the Goldman House view through the depths of April. How much positive would you say you're turning, if at all?
Yeah, I would say we've avoided a worst-case scenario. So we've avoided the sort of production disruptions that we would have seen with tariffs at levels that would have blocked trade between the U.S. and China. We had already assumed in our forecast that a 145% increase in the tariff rate was not going to be sustainable. But the decline after the deal was a little bit larger than we had previously assumed. So we now think that the increase in the U.S.'s effective tariff rate will be about 13 percentage points versus 15 before. That means a smaller increase in prices. That means a slightly smaller tax-like hit to disposable income and to consumer spending. And we've also seen, of course, over the last month, a gradual easing in financial conditions, which means, surprisingly to me, that despite having tariffs that are about 8 times as large as in 2019, markets taking it pretty well. And so that means less financial amplification of the growth hit. So,
some of your peers might argue, a 13-14% average tariff is still a tax hike, one of the biggest since the Second World War, and the economy's got to absorb that. How hard will that be?
Yeah, I think that's absolutely right. I would say we are in a good place, as good of a place as we could be to absorb that, in that profit margins are starting high, the layoff rate is starting low, private sector balance sheets are starting in very good shape, and so companies probably won't be jumping to lay off a lot of people. We do think this will be a year where economic performance is mediocre. 1% GDP growth is about half of our estimate of potential. We think the unemployment rate will drift up a little to about 4.5%, but a less bad outcome than we had assumed under higher tariffs.
That kind of muddle through or, just above stall speed type of outlook, where does that leave the Fed? Because if they're still getting job growth, if it's just a slow drift higher in the unemployment rate, and they're still going to be a little bit stringent about trying to get PCE inflation down toward 2%, does it just mean on hold indefinitely?
I think the message from the FOMC has been inflation's high. Some survey measures of inflation expectations are high. The bar to cut is going to be higher than it was in 2019 when they did move very preemptively. This time, they want to see some real evidence in the hard data. What we're penciling in, I would say, is mediocre, but not quite weak enough to draw them to feel like they have to cut in an environment where high inflation makes it a little bit awkward. So we took out the insurance cuts from our forecast. We now have them waiting to cut until the tariff effects on inflation have passed and inflation has come down. So we have the first cut now in December, continuing to next year. Same 3 cuts, same terminal rate of 3.5 to 3.75, but different motivation and starting later.
That's becoming an increasingly common view, that December cut. We were talking about the 30-year yield today, and watching House Ways and Means do this 17-hour markup. Are Treasury yields reflecting anything that's happening in this process?
I think, the market is kind of coming to terms with maybe it's not as likely that they'll be forced to cut soon. And so that has some implications for the back end as well if the cuts come later. We wind up, thinking about kind of the longer term terminal point, the neutral rate anchor for the back end in basically the same context as before. I do think that we've learned that the administration doesn't want to hit financial markets and the economy too hard. That means, well, if you have 35 rather than 45% probability of recession, less risk of the very deep cuts that you would normally see in a recession. That, too, has implications for where the curve should be, and I think that's part of what's being priced.
I mean, it's such a whipsaw in the narrative when you consider that we were talking about, these punitive tariff levels possibly alongside this idea we're going to get some fiscal contraction, right? I mean, whether it was through DOGE or the budget process. And now it looks as if we're not really going to have much fiscal payback, at least on offer right now.
I think that's right. The tariffs, you can think of like a tax hike, but the tax cuts, the spending cuts, some spending increases, our assumptions there have not changed that much since Inauguration Day. I think on net, the effect of these things on the economy would be small relative to the tariff effect. The economic picture for 2025, to me, is all about the tariffs. Some aspects of that, the tax-like impact, I think are pretty straightforward. We feel pretty confident in the impact. Other effects, like the effect of uncertainty on businesses willing to hire and invest, there's a lot more uncertainty there.
Where's the trend on like net disposable income? Is there a spread between that and actual spending?
I would say for a variety of reasons, including a deceleration in disposable income, consumer spending growth ought to decline this year. We have seen a huge decline in immigration over the last year and a half. We just don't have as many people to put to work to create jobs for. That's a hit to disposable income. We've seen wage growth continue to moderate. The wealth effect has gone from positive to more neutral. And of course, tariffs function like a tax, so that will further reduce disposable income. The hard question is, consumers have been signaling a lot of anxiety about the outlook. For example, we've seen big increases in people's concerns about getting laid off, I think connected to some of the trade war fears. Is that additive to the slowdown that you would get from all of those fundamentals? Perhaps a little bit, but I would still see this as a mediocre but not overly weak consumer picture, same as our broad economic forecast.
Right. Interesting.